we are going to, I think people are still coming out of the meeting rooms, so we'll see everyone populate. But we are going to start our session with the London Stock Exchange. Okay, so we got bad news and good news. A couple of days ago, our speaker, Chris Mayo from the London Stock Exchange Group, ruptured something on his body, and he has to go in for emergency surgery. So while he was injured, he called and says, "Listen, I have a backup to speak for me." And I go, "No, we sort of want you to speak." And he goes, "I want to speak too." So the guy's injured, he's in pain, and he's like, "Let's do a pre-recorded video." So I have this video interview with Chris Mayo from the London Stock Exchange, and we're going to hit on a few points. So I want you guys to, if you have a pen and paper, just write it down so you can have an understanding of what we're going to get into, because part of it is technical trade talk, but we're essentially going to talk about the London Stock Exchange and what is the alternative investment market and who Chris Mayo is and why Chris is important. We're going to talk about the 2 ways to go public on the London Stock Exchange and which one's relevant for you. And that's going to take about 10 minutes. And then in the next 10 minutes, we're going to compare like how the London Stock Exchange AIM market came about and compare them to NASDAQ. And we're going to talk about being a venture capitalist, having your company go through an IPO. Well, how do you exit without like losing all your money in the capital markets, right? Because if you trade at really thick trading volumes, you could impact the price and lose a lot of the value while you're trading. And then from time to time, people will say, well, if this is not the main market and it's a junior market, then it's sort of like American penny stocks and pink sheets, right? And the answer is, we'll find out when he talks. And then he's going to talk about the economics of doing it and why it's so cheap to list on the London Stock Exchange. It's so accessible, right? If you want to do an IPO here in the US, several $1 million. So that's going to take another 10 minutes. And then, 13 minutes spread talking about who is driving all the trading volume on the London Stock Exchange and AIM versus who drives it here in the US. And then it gets a little bit more technical. And then we get into the process of going public. And that's where we close it down. So just know that as the framework. And we're going to start. So I'm going to share my screen here. Give me a second. Here we go. Hi, everyone. I'd like to introduce you to Chris Mayo of the London Stock Exchange. Chris is here to talk about the alternative investment market with the London Stock Exchange. And the reason why I believe it's a very important conversation for us to have is because we operate under a set of different rules, regulations, and laws here in the United States. There's some opportunities in London that we need to learn about to understand how to better access liquidity and capital for our portfolio companies. Many of us are new and emerging fund managers. LPs want to talk about how we're working to exit. We want to have additional resources and tools at our disposal to make our fund successful. And that's why we have Chris Mayo. So Chris, would love to have you introduce yourself.
Thanks a lot, Boris. Really appreciate the invitation to speak today. And so, as you said, my name is Chris Mayo. My title is Head of Primary Markets for the Americas at the London Stock Exchange Group. Really, all that means is I get companies to either do IPOs or secondary listings in London from across the Americas. And the majority of my work is with private companies in tech and life sciences, and most of those tend to be from the US, and most of those tend to be smaller companies. So just to hone in straight away on where we're going to focus today, I typically work with companies, say, 50 million to $1 to $2 billion of valuation, where we think we have specific, advantages versus US exchanges when it comes to helping companies go public. And we'll go to those a little bit further detail during this discussion. But also want to say, who am I, and why am I actually why am I an authority on this particular subject matter? I've been in the investment banking business for about 25 years now. I first started in the late 90s, and I've done IPOs in lots of different countries, including the US and the UK. So I understand how things work in different jurisdictions and what the relative merits are of accessing the public markets in lots of different countries. And I think it's important to say, the point of this discussion is not to denigrate the US capital markets. The US capital market is very deep and very important.
Absolutely.
I just think that there are certain situations where the UK public market can be at least an initial gateway for some US companies to access public capital at much lower cost and at a much kind of smaller size than can be achievable in the US. I just want to get that across. I think it's something that people probably don't really realize, but we've got a lot of success stories that I'll be happy to talk about today.
Into this, let's talk about what is AIM, or the alternative investment market, and but more specifically, let's talk about some of the nuances in terms of what role does it play in the UK, and you could compare it to something like the NASDAQ. Does the London Stock Exchange have a NASDAQ, or does AIM fulfill that role? Or I think that's the conversation we want to have.
Yeah, I mean, I think there are some similarities between AIM and NASDAQ, but let's take a step back and talk about the regulatory system in the UK. So under the London Stock Exchange umbrella, we have two main ways for a corporate to go public. One is the main market, which is where most of the larger companies go. When I say larger, we're usually talking $500 to $1 billion of valuation before you're considering going to the main market. And then we have what's called AIM, originally was called the Alternative Investment Market, that's been going for about 26, 27 years now. That market was originally designed to help smaller companies access the public markets. And it operates under a different rule book than the main market, even though both are under the London Stock Exchange umbrella. For the main market, if you want to go public, you need to have a prospectus or a registration statement that's approved by our equivalent, the SEC, which is called the UK Listing Authority, or UKLA. For AIM, you don't need to do that, because essentially AIM is what's called an exchange-regulated market. We have a regulatory team that sits within the exchange, the AIM regulation team. They regulate what's called nominated advisors. These are essentially investment banks. It is these investment banks that do the diligence on the companies and attest to the suitability of those companies to be listed on the AIM market, the AIM growth market of the London Stock Exchange. So there is a difference there between the two markets. AIM really has regulations which are suited towards smaller companies. And so just to take an example, actually, the UK, we have half-yearly reporting rather than quarter reporting, which massively reduces the burden on companies. And obviously that, for a smaller company, is a huge advantage. So I think it's important to understand those kind of differences. Now, you talked about what's the comparison with the US.
Let me just check in real quick with so what I've gathered so far is your main market has your more conservative, dividend paying, older, well-established, cash flowing companies. AIM is the place for it's the mechanism that the London Stock Exchange launched to help new and developing companies get liquidity, find funding, and to grow. It's unregulated, but you do.
No, I wouldn't say unregulated. I'd say it's regulated in a different way. So it's regulated by the exchange rather than a supervisory authority like the SEC. So there's certainly regulation, certainly diligence that goes behind an AIM IPO is very, very similar to main market one, because obviously you don't want to have any liability issues, but it's just done in a different way.
So the groups that manage that process would be the nomads, right? Which are the investment banks or broker dealers that you spoke of previously.
Correct.
Okay, good. We could
now. So just to draw the kind of line between the US and the UK. So obviously there's big differences in the UK versus US regulation when it comes to capital markets. And the UK is generally easier to go public than the US, even on the main market. I think it's important to say that as well. Now, making a comparison between NASDAQ and AIM, I would say the difference is AIM is somewhere kind of today where NASDAQ was 20 years ago. So very small companies used to go public on NASDAQ with quite a lot of frequency in the late 90s into early 2000s.
Right.
Because of changes in regulation, that essentially died out, and also because of massive increase in private capital availability in the US. So to take an example, these days, if you're going public on NASDAQ, you'll be definitely above $1 billion of valuation, certainly as a tech company, really not viable to go public below that. For AIM these days, a typical market cap IPO will be $150 million. Obviously much smaller than NASDAQ. So we can help those smaller companies in lots of ways. AIM is kind of the way that NASDAQ was 20 years ago, helping those smaller companies. And so there is a difference in that perspective. But what I would also say people don't understand is the quality of the investor base for a 100 or 200 or $300 million market cap company in the UK is really high quality, where you have brand name established institutional investors which will invest in much smaller companies than their US counterparts. So Fidelity or BlackRock in the UK, they'll have a smaller company fund will invest in AIM stocks. BlackRock Fidelity in the UK, and so in the US, is not investing in $200 million market cap NASDAQ listed companies. So there's a big difference there. I would also say the reason why AIM evolved this way is historically the UK did not have a very strong or deep VC market. I think that's changed in the last 5 years or so, but that's the reason why AIM needed to step in and, create, fill that gap for if you want to raise 10 to 50, $60 million, AIM is perfect for doing that. And so we didn't have a VC market really to do that until very recently.
So the other note that we've just picked up is for our portfolio companies, if they're eligible to list on AIM, we set them up with the Nomad. There is sort of like a revenue guideline though, right? I think you try to target companies that are doing 10 million plus of revenue annually. We can IPO, and as a fund owner in the portfolio company, I can figure out how to trade out my shares, right? Okay. So do you have any examples of companies that have had some success stories that are U.S. companies that we may or may not know, but have done well on the London Stock Exchange?
To elaborate on the comments you made, for a tech company, doing $10 million or more of ARR, I think that's kind of a good entry point to the London market. And then probably if you go up to 100 million, usually at 100 million, that's when people start to think about NASDAQ as an alternative. But we can help companies between those kind of two figures that we just talked about. Now, for medtech companies, we frequently get pre-revenue companies. So I don't want to say that we can't have a pre-revenue company, but that tends to be in the medtech area, and we have a lot of success actually in medtech specifically from the US. Now let's take, and you also said trade out as an existing investor. Very important point. It is much easier to sell down as an existing investor at the point of IPO for a UK growth IPO than it is for a NASDAQ listed IPO. And we've got stats to back that up. So if you're a VC investor and you want to get partial, or a founder, you want to get partial exits at the point of IPO, much easier to do in an AIM IPO than it is for a NASDAQ IPO. In fact, NASDAQ IPO is almost unheard of. You'll wait till the expiry of the first lockup before you'll start to sell. Now, let's take some specific examples. We had 2 video gaming companies from the US that went public in London last year. One was from Seattle called Tiny Build. They did a $200 million offering with about a $500 million market cap. Their revenue was around about $30 to $40 million from recollection at the point of IPO. So for that particular IPO, just over $200 million deal size, I think about 60 to 70% of that was sell down by existing shareholders, taking money off the table at the point of IPO. As long as you've still got skin in the game, people are willing to accept that. And obviously they raise primary capital as well. Then we had another company from Austin, Texas called Devolver Digital in the video game space. They raised, well, their IPO size was about $260 million. Again, about 70% of that was sell down at IPO. My recollection is that their revenue number was something around $75 million or so on a historical basis at the point of IPO. Their market cap was around $1 billion. So we can show that we actually get, we get a lot, but I would say on the flip side, we also get much smaller companies. So take another example from Texas, a medical device company called Bellascura. They have 0 revenue, but they did have an approved product with the FDA. So they're going through commercialization. They raised about $24 million. Recollection was about $65 million. I could be wrong on the actual market cap number, but it shows we can help with much smaller companies as well. So I talked about 50 to a couple of $1 billion. You really, from those different kind of companies, you see that range, that we've actually been, and these are just examples from last year. Many. On the Bellascura side, they raised $24 million at IPO. They actually came back and raised about another $15 million a couple of months ago. at a substantial premium to the IPO price because they're trading way above their IPO price, which not many IPOs in 2021 in the US or the UK are doing. They've had a very successful run, and they're doing much better with regard to their commercialization. But if you take these examples, the ability to raise primary capital, the ability to also sell down as an existing investor, we can show those examples for both tech and med tech companies.
Yeah, so a few things. You started that segment by talking about these companies also have the ability to grow on your exchange, and as they're succeeding and scaling, to then list on a much larger exchange, whether it be the main exchange with the London Stock Exchange or with the NASDAQ. So that's a well-defined process that you have, right? The second thing you pointed out was that you could trade down or trade out of your position as a venture capitalist relatively easy or easier on the AIM and London Stock Exchange at the time of IPO.
Yeah.
Right. So that's a keynote that the guys have to. So if there's a moment you have to trade down, if there's a dollar amount that you're trying to get, the best time to try to get as much of it would be at the IPO, and then you probably have to come up with a programmatic percent of volume type trade strategy going forward if you want to trade the rest down later, or if you want to hold on to it for a long time for the remaining shares you have. And then the third point was on having your initial raise. I think as long as you keep performing, like in any market, private or public, you'll continue to get research, you'll continue to see trading volume, and then you could come back for a secondary offering. You could have another offering again, correct?
Yeah. So I'll take a really good example. We have a company called Boku, which is a mobile-based payments company. That's backed by Andreessen Horowitz, Benchmark, Khosla, NEA, Index, names you may have heard of in the VC world. That company was founded in San Francisco, but went public a few years ago in London because it probably had about $25 million of revenue. A good size for AIM, too small for NASDAQ, quite frankly. They did an IPO, $59 million. 60% of that was secondary sell down by the VCs. Since that IPO, and then what would typically happen then is you would have 6-month lockup or 12-month lockup, depending on the situation. The VCs then come, and then if they want to do large blocks, they'd probably do that on an accelerated book build basis with the banks to get further sell downs after the first lockup expiry. But then once they're actually down to a relatively small amount, they'll just be dribbling that out, as you just talked about. Right. And so the VCs in that particular company are down to, some of them are out completely. I think the largest one probably still has 1% of the company after basically being able to monetize just in the same way as you would with a NASDAQ IPO, although you can get more at the point of IPO than you can at NASDAQ. Now, the second thing to talk about with that particular company, they've come back and done follow-on capital raises to fund acquisitions. So they raised primary capital, they bought companies. They've also issued stock directly to targets in the US to buy those companies. So that's one of the advantages. If you actually think about the advantage of being a public company, it's the speed of being able to raise primary capital. If you're raising relatively small amounts, you can probably raise that within 1 day on an accelerated basis, even for a primary raise. And also you can offer your stock directly to target companies as a way of financing the acquisition directly. And Boku is a good example of a company that's done that to finance its acquisition activities. You also said about companies moving up. So we've had a number of companies that have started on AIM and then gone to NASDAQ when they become larger. So we can be a very good initial gateway or stepping stone to the US market. So recent examples of that include Renalytix and Maxite. We've also had a few companies that have gone up to the main market from AIM. The reason why they would do that is they can get index inclusion in their main indices, which leads to passive demand. And I'd say that companies typically think about doing that when they're between 500 to $1 billion of market cap, because then it can actually be material.
Good. So let's move on to demystifying some taboos about what it's like to list and work with the London Stock Exchange and AIM, because you talked to the only people we have exposure to mostly would be people in the U.S. market, lawyers here, bankers, and you'll talk about, hey, this is what we're going to do, and they have all these preconceived notions of what a market like AIM may look like. They'll compare it to, the the delisted or like penny stock type exchange. Yeah, the pink sheets here in the U.S. And they're like, you're not going to get trading volume, and it's going to be expensive. Why would you do an IPO? It's going to cost tens of millions of dollars, right? But let's start talking about the cost barriers to doing an IPO. In the U.S., it's a few $1,000,000. Could you talk a little bit about what it'll cost to do an IPO on AIM?
Yeah, I mean, I think that the highlight is that I think a lot of people in the US go, oh, IPO must be super expensive. IPOs aren't cheap anywhere, but they're certainly a lot cheaper in the UK and on AIM
relatively speaking.
Yeah, no, I think that's the point. I mean, I'm not going to say that IPO is cheap. You'll probably spend, fixed costs, probably $750 to $1 million of fixed cost doing an IPO if you get right to the end. And obviously then you've got the placing or the underwriting fee. But just to take the placing or the underwriting fee, for an AIM IPO, maybe 4 to 5%. For an NASDAQ IPO, it'll be 7%. So there's a big difference there already. The other fixed fees will be in the millions of dollars on the US, when it'll be below $1 million in the UK. So I think you're probably talking, at least a third of the cost. It could be potentially even less expensive than that, depending on the size of the company, when you compare the US to the UK. And then the ongoing cost of being listed is probably 5 times as much in the US, because you have things to worry about. Your auditors will charge you a lot more because of the liability of you being a public company.
Right.
And to be doing things to the PCAOB standards that you're expected for an audited public company in the US. Insurance costs will be dramatically higher in the US than they are in the UK. And just to give you an idea of why that is, the likelihood of being sued as a public company in the US versus the UK is night and day. So why
is that, by the way, particularly in the UK?
I think it's just partially culture. Investors tend not to sue companies when things go wrong unless there is clear kind of evidence of malfeasance.
Yeah.
Where in the US, you will get sued if your share price goes down, because they'll point to something in your disclosure that will say, that's misleading, therefore you need to pay it. And people will just pay to make this go away in the US. In the UK, they won't. And when I'm talking about a big difference, I'm talking about a handful of class action lawsuits in the UK over the last 10 years versus 250 to 300 a year in the US.
Oh, man.
I can probably count on one hand how many there have been in the UK in the last 10 years.
Right.
Versus hundreds per year in the West.
Yeah.
It's very, very different.
It's a big business in the US. Like law firms they find investors to come up with reasons to sue public companies.
Yeah.
Man. Yeah.
So, I mean, that's one thing. The cost is night and day, and the cost of being listed is much, much more reasonable in the UK, and it's something that a smaller company, and as I said at the start, you'll be half-yearly reporting, not quarterly reporting. So twice instead of 4 times.
Yeah.
That is just a big, relief for the finance staff.
So just give me, a ballpark estimate on cost, right? So we have, the cost to get it done, and then you have your finance costs, the bankers charge. So to get everything set up, it'll probably cost $250,000, $500,000 for AIM.
No, I think 750. If you're doing all of the fixed costs, I'm talking lawyers, accountants, PR, our fee, which actually isn't that much, and it's on our website. Either calculate it, it's basically based on market cap. You can see that 750 feels about right for that. And then you've got the bankers will charge a success fee on the which is a percentage of the proceeds raised or the deal size.
Yeah.
So that's usually 4 to 5% on AIM versus 7% for the equivalent on NASDAQ. Again, a big difference.
Yeah, it seems as if the culture there is more around, focuses a lot more around accessibility. I could be wrong, but that's sort of what I'm getting from you.
Yeah, I mean, for a smaller company, the market is much more approachable. I think also I need to reiterate this again. The investor base, and you talked about the pink sheets before, I think it's important to understand, If you're a $100 million market cap company and you're listed on the pink sheets, you're not going to have a high quality investor base. In the UK, as a $100 million company, you can have a very high quality investor base of that size. Now, I think the problem is that there's a lot of people who think about AIM and they think about, say, around 2005, where there was a big rush to go to AIM because of kind of a reaction against Sarbanes-Oxley.
Right.
So what it meant was we had a lot of small companies go public who actually weren't really suitable to go public at the time. And I think there's been a real shakeout in the market. We have a lot fewer IPOs. They're bigger and they're high quality, and the people investing in them are brand name institutional investors. A lot of Americans remember AIM from 2005 and think casino. You know, the quality of what we've got today is night and day to what we were in 2005. And so when you say, oh, I can have a BlackRock or a Capital, you know, or Schroders investing in my IPO, that's something that's achievable for a $100 million, $200 million market cap company on AIM, not achievable in the US market, even on NASDAQ.
So let's change the conversation to trading volume, and let's do a comparison, and let's talk about the difference in nature behind those trades, right? Because the other story I hear is you'll never be able to trade out of your position. So you've debunked that, talking about ability to trade out at IPO. But let's say you don't want to trade out. Let's say you want to hold on to the stock. And you want to think about, you know, the health of the trading volume. Does the AIM market at least trade comparably to the London Stock Exchange? Or how should we look at that?
Well, certainly for companies of the same size or similar, I think the free float market cap is the key determinant of where you have liquidity. And so similar companies of similar size between the main market and AIM actually trade very similarly, because there isn't, it's not like there's an AIM investor base and there's a main market investor base. It's the same investors. It's just guys who are running either UK smaller company funds or UK equity funds. They're not AIM funds or main market funds. They're the same guys. Okay. Also, there's not an AIM trading platform and a main market trading platform. It's the same trading platform. And I think a lot of people don't understand this. But what I would say is, when you compare it to the US, average daily trading volumes tend to be lower in the UK than they are in the US. However, the composition of that trading liquidity in the US is not necessarily helpful for you if you want to do a liquidity event. So what I mean by that is, when you look at who's trading, a lot of it's retail and a lot of it's automated in the US. If you say you wanted to sell down as a, you know, say you're a VC, you wanted to do a sell down, accelerated book build, there's not actually an individual to go to with a lot of that liquidity, because there's no one actually making a decision. In the UK, the people who are trading are actually real people. So what you will find is your ability to sell down as a VC or to raise primary capital as a company is actually a lot larger than you would expect relative to the average daily trading volume. So you can have companies, you know, do large sell downs, or investors do large sell downs, and they'll be able to do it at single digit discounts to the prevailing share price. And I think for an American looking at this, certainly a market participant will say, I cannot believe that company can raise this much when it only trades, say, $1 million a day or 500,000 a day. But actually, there's a lot more liquidity out there than people realize. I think it's also important to understand that the broker dealers, or we just say the brokers in the UK, are very important in sourcing liquidity. So what will happen is that an institutional investor may like a company, but they will turn around to the broker and say, okay, I mean, it could take me quite a while to accumulate a large position in this company, but instead, why don't you just come to me when there's a liquidity event, and I'll be good for $3, $4, $5 million. And so that's why you're able to get these much larger deals executed at good prices than you would really expect, given the actual quantum of the average daily trading volume.
So let me try to unpack that, because I was once a securities, inequities trader here in the U.S. If I would look at the London Stock Exchange trade volume and compare it to the trade volume of some of the exchanges here in the U.S., particularly our larger exchanges, we'll see a whole lot more volume here in the U.S. But one of the unique differences is the nature of who's trading. When I trade billions of dollars, tens of billions of dollars with bots, right? So a lot of our trading volume, and then they're like machines trading on their own, trying to find some sort, trying to execute in an arbitrage opportunity out there in the market. So a large portion of our trading volume here in the US isn't done by
Different way of
people.
people. Yeah,
It's done by computers. So
correct.
if you take that away, then you what you have to look at are, well, who are the active traders that are up, and there's still traders like that in the US. At my broker dealer, we still had guys who were looking out for a particular type of stocks for particular investors. What we're
Yeah,
saying is that type of trading is more pronounced on the London Stock Exchange, right? Where you have active investors who are looking to acquire certain companies, and they have their book orders in at their brokers, and they're actually buying. So there's a
yeah,
very healthy trading volume there. Although at initial glance, it'll look like, oh man, it's so much lower than the US market. But the truth of the matter is, it's just very different traders behind those
yeah.
trades.
It's
Yeah.
difference in market structure, Boris. So I agree entirely with what you're saying. I would say AIM is an active investor market, and a lot of those investors are buy and hold. And by definition, if they're buy and hold, that means less liquidity. What you do, I mean, that's the thing about with the US is the shares that are trading on stock that's trading will be churning multiple times per day.
Yeah.
Whereas on AIM, that would be very unusual. You've got guys who are making a conviction-based decision to invest in the company, and they're wanting to hold that company for, in many cases, years, and also add to their positions if the company delivers on its promises. So the market has a very different character to what you see in the US.
All right. So you just brought up two things: delivering on management goals.
Mm-hmm.
The other thing we spoke about was trading at a small discount. So let's deal with the topic of, me being a venture capitalist. I sold out of, a certain percent of the ownership into a particular company that I have, but I want to hold on to, a smaller percent, maybe 10% of the position, right? And
Yeah.
in, 2-3 years later, I'd like to sell out. One of the notions you brought up was this notion of selling at a minimal discount. What does that mean? Could you unpack that for the audience?
Yeah, I mean, at the end of the day, you should be able to sell close to the market price. And so there, if you are supplying a large amount of stock into the market, you're going to have to take a discount. Now, what would happen if you were looking to sell, a reasonably large position, say something like 10% of the company, then you would probably do that on an accelerated book build basis. So what happens, you would go to the brokers who you've been working with and say, go out to the market. They go out to the market either after the close or before the open and say, we're offering this to investors, and they would basically build a book, and he would hope that you'd be able to do that single, the clearing price for that amount
Right.
will be a single-digit discount to the prevailing market price. That's really what you're targeting.
Good.
Obviously, the more you're selling, the bigger that discount gets. So obviously, there's kind of a fine tuning to get the right amount, and obviously the investor may have a floor on what price they're willing to accept. But that's the way these things are typically done. Now, if you're looking to a much smaller amount, you can go to that broker and say, just dribble this out to me into the market. And obviously you can have, limit orders on what kind of prices you're willing to take. But I mean, it depends on the size of the block that we're talking about.
Yeah, and the reason why I brought that up is because I wanted to demystify this notion that you'll be stuck with large shares for companies that are performing and doing well. And what you touched on was, the ability to take a small discount. So that's real, market trading talk that happens here in the US. And the notion is, if you're going to sell down a really large portion of shares of a company that you own that's way larger than the average trading volume, let's say, 1,000 shares or 1 million shares trade a day, and you're trying to sell down, 5 million, it's going to take you some time, and you're probably going to impact the price, right?
Well, yes.
I just want to make it clear. So there are ways you can do that. without impacting the price, right? If you bring in all this supply to the market, one way that Chris brought up was you could negotiate a block trade with someone that's looking for it, and you could do it, privately, right? The other way you could do it is come up with a programmatic trade and do it over multiple days if you'd like, right?
Yeah.
It'd be a small portion. But the point being is it's a healthy market, and you're not going to be taking a huge discount. If you're doing that with a penny stock and you had to sell right away, you're going to take a significant discount.
Yeah.
Right.
It's going to blow up the market. But I would say is, I mean, when you do the block trades, typically what happens is you'll say, I'm selling down this amount. Oh, and I'll take a short-term lockup for the rest. Because really what that does is it guarantees to the market that there's not an imminent price of additional supply, and that reduces the discount as well. But obviously those lockups get progressively shorter as you're reducing your stake in the company. But what I'd say, yes, I mean, like I said, I used Boku as an example before. Boku, I'd say the initial sell downs were block, like on an accelerated basis. Then as the kind of residual shareholdings got relatively modest, below 5%, they were just dribbling those out. And now I think most of the VCs are completely out and have been for some time.
All right, so let's talk about how you get discovered as a company that is IPO'd. One of the nomads or one of the brokers will, if they're taking you public, they're probably providing research coverage, right? I mean, they'll publish.
They have to. So, I mean, actually, this is important. Let's talk about process and let's talk about the role of research, because it's different in the US versus the UK. So the UK has significant process advantages over the US. So one of these, and so let's talk about the process of how you'll go public in the UK as a US company. A lot of times what happens is I find companies, I'll go to lawyers, I'll go to VCs and say, this is a profile of company that fits for London. What have you got? And then I'll have, people will bring companies to me. And then on the basis of that, I'll go out to brokers, on a no names basis and say, here's the profile of company on a no names basis. Are you interested? And I'll basically curate a list of, say, 5 brokers, which have the ability to execute IPOs for US companies in London, good research in that sector, right kind of size focus for that kind of company. Now, typically what they'll do is the company will have a conversation, they'll probably sign an NDA and exchange information, and they'll pick 1 broker or 2 brokers, depending on their size, to work with. Right at the start of the process, those brokers will take the company to meet investors. That process is called testing the waters in the US. Now, to get to that point in the US, you have to have a draft registration statement in place. Probably cost you $1 million to get to that point. In the UK, you don't have to have any of that. You just need to have a presentation. You may do some verification on that presentation with lawyers. But usually, we're talking minimal cost to go and meet investors at the start of the process and get feedback. If you don't like the feedback, you can
don't go public. Save your money.
You can do something else.
Yeah.
And you will spend virtually zero. This is not something you can do in the US, but something you can do in the UK. As you go through that process as well, in the UK, we still have deal research for IPOs. What that means is the bank or banks doing your IPO, their research analyst you'll give them a presentation which has the same information as your admission document or prospectus. They will write a research note, and before you go in the roadshow, the research analyst will distribute this research note to institutional investors. This is something you can no longer do in the US, but you can do in the UK, and it's a very important, kind of point in terms of price discovery. So on the basis of that, the banks will gather feedback on valuation, and that's how they set the price range. As a result of it, and then you go on the roadshow after that. As a result of that, it's very unusual in the UK for deals to price outside the initial filing range. Whereas in the US, because you can't go through these different price discovery mechanisms, it's very common in the US to price outside the filing range, the initial filing
because
range.
it's mispriced.
Because you don't have the opportunity to do discovery in the same way.
Yeah. Yes. Price and discovery. No. So I think what we've learned here was there is research coverage coming from the nomads, or the brokers, investment banks, as we call them here in the U.S. And the other notion that people talk about is, well, if you don't perform, then they'll take coverage away. And I want to liken that to the private markets here. If you don't perform, you're probably not going to raise any additional funding. That's the same thing for a public company. No matter where you are in the world, you don't perform, you're going to lose research coverage, and it's going to be difficult for you to raise money. And that doesn't say you can't turn things around and change that. But when you hear stories around companies losing research, it's probably because it's a lack of performance. And what may end up happening as a result is less liquidity in trading for that particular company.
But I think there's also another important distinction between the US and the UK markets here. So in the US, the banks will do your deal and they'll say research is independent. So after the deal, you're on your own. And what you would typically do is you'll hire external IR support in the US. In the UK,
that's right. I need an IR. I need my PR and IR investor relations group, and it's very expensive.
Yes. So in the UK, the broker will essentially do a lot of that work for you. They'll maintain a relationship with you post IPO. It's called in the UK. It's called a corporate broker. Essentially, the investment bank. They will help you. They'll provide you with IR support. They'll help you set up your non-deal roadshows and your deal roadshows. They'll help you with trading insights. They'll be publishing research. They will maintain a much stronger relationship with you than would ever happen in the US. So you get you get much stronger aftermarket support as a smaller company in the UK than you would ever get in the US. In the US, you would have to pay for it.
Right.
And so there's really a fundamental difference in how you're treated as a company and what relationship you maintain with the banks post IPO in the UK than there is in the US. And I think that's an important distinction to draw.
I think we're all done here, Chris. I think that was a wealth of information. I think people are going to be playing this video over to try to look up what some of the technical terms are. Feel free to email me if you have questions, guys. But it was an amazing overview of our ability to list our companies on the London Stock Exchange to get liquidity. The other thing I'd like to do is probably do a soft leak of an initiative that you and I may have coming up later in the year at the London Stock Exchange in New York City, where you could talk about something that's not possible here in the US because of the 40 Act, actually IPOing our own funds, right? Do you want to talk about that? Because someone said that and it just didn't register with me. Oh, you could IPO a fund, and I'm like, no, that's illegal. And they're like, no. And I'm like, what do you mean IPO? Like, I could have investors buy shares of one of my funds, and I could use the money, the proceeds that came from buying those shares to invest and to take management fees. They're like, yes. I said, that's illegal. And they go, you need to deconstruct your mind of the U.S. market and think differently because things are done differently in London. Do you want to give us a sneak preview into IPOing our funds?
Yeah, so the 40 Act imposes a lot of regulation on it in the US that makes it pretty much impossible to do this. You've got limits on things like, diversification, leverage, all kinds of things. Also, what fees you can charge. In the US, in the UK, we don't have that. So we've been able to attract a number of either PE or VC funds to raise externally managed vehicles where they're taking both performance and management fees.
Yep.
And those funds, I mean, for instance, for some of the VC funds, we've had funds listed in London which have had exposure to, say, Uber before its IPO and a number of other, Wise, which is formerly TransferWise, before they IPO'd. So, the average investor, the man on the street, was able to buy these funds and get exposure to the underlying portfolio of private VC style investments. And that's something that the UK, listing environment allows for because we don't have the same, strict regulation around investment companies that the US has. And so we've been able to attract a number of US managers to look at, taking advantage of that particular environment to raise funds to, basically it's permanent capital that they're raising because these are just tradable shares and they're able to invest that in new private company opportunities.
Yeah. So I learned about this through some of my former colleagues at Goldman Sachs. They run a group called Peters Hill, and but there are other major funds in the U.S. I just think it's not common, apart from a lot of the major institutions out there. So would you know like one or two other like marquee names that people would know that would do funds, even names out in Texas or California for smaller funds?
Well, I mean, certainly in terms of, I'm trying to think, Draper Esprit is probably the most
Draper.
famous, is one that it's now called Malton Ventures,
Yeah.
that's listed in London.
That's Tim Draper and team, I'm assuming.
Well, it's an affiliate, yes.
Affiliate, yep.
We've got Bailey Gifford has a fund, but Bailey Gifford is really famous for investing in a number of Silicon Valley companies at an early stage. That's called the Schiehallion Fund. I'm trying to think from a US perspective. We've got a biotech fund called RTW. That's a famous US-based biotech investor.
Yep.
We also have Biopharma Credit, which is run by Royalty Pharma, which is a company listed on NASDAQ. So there are a number of different funds in this area. So yeah, I think, and we've got Augmentum FinTech. I mean, like a specific FinTech-related fund. There's lots of different funds here. So this is obviously an intriguing opportunity for for fund managers to again access a different pool of permanent capital. And again, it's permanent capital. So
right.
This does not need to be the capital does not need to be it's not 10-year fund life. It's a permanent capital vehicle, and obviously a lot of people like that, and obviously can raise further capital for these vehicles as well, and that's pretty common for them to be able to grow over time using follow-on offerings.
Yeah, so guys, stay tuned for additional information on that. Chris, thank you. If you'd like to give the audience some information on where they could learn a little bit more about AIM, where should they go to do some additional reading?
Well, I think they should just connect with me on LinkedIn, and I can provide them with all the initial, kind of content they need. We're also about to launch additional website pages, but I'll be able to broadcast that through my LinkedIn feed when they're ready to go. But those should be ready in the next, 1 to 2 months.
Chris Mayo, M-A-Y-O. Very easy to find.
Like mayonnaise.
Chris, it was a pleasure. Thank you so much. Good luck, and I look forward to talking to you soon and getting together soon.